Alright, let's dig into what's moving money today, starting with AI chips made in America. NVIDIA just rolled out its first Blackwell wafer produced at TSMC's Phoenix campus, which really shifts parts of the AI supply chain onshore.
Yep. So that move basically cuts down on lead times and even reduces geopolitical risks, right?
Exactly, and it boosts the capacity for data centers. It's like, imagine an assembly line that's now right in your backyard, instead of waiting for a shipment from overseas. Making everything a bit more agile.
Yeah, absolutely. And that feeds right into the AI CapEx flywheel, benefiting not just chip makers, but also tool vendors and power and cooling suppliers, right?
Right on. Moving on to the global growth baseline. The IMF pegs global growth at about 3.2% in 2025, with advanced economies a bit slower, around 1.5%, and emerging markets over 4%. It's not a boom, but more like a steady grind higher.
Steady indeed. So even if it's not a boom, the balance sheets are still strong and liquidity is there, especially with EMs tied to commodities and manufacturing reroutes. It seems like a solid, if unexciting, backdrop for investors.
Exactly, but let's also talk earnings versus valuation. The S&P 500's trading at around 23x forward earnings, its highest in 5 years. This is where things get a bit tricky.
Yep, tricky indeed. Right, because even though bank prints were strong and chips caught a bid, there's this lingering nervousness about credit risks among some lenders. How do you see that playing out?
Well, it's a reminder, don't chase breakouts without a plan. You want companies that convert revenue into cash with clean balance sheets and solid pricing power. Now I'll say,
Yeah, that's
but
crucial.
one might argue that the market's rally shows confidence in growth. However, my concern is that the high valuations might be masking deeper risks.
Interesting. I mean, it's like riding a fast train, but not checking if the brakes are working, right?
Exactly. And then there's that risk lens from Europe. The Bundesbank suggests the EU needs a tougher stance on China trade. That could cause significant dispersion with autos, machinery, and luxury sectors wobbling, while onshored components
That's
win
a real
out.
eye opener. So overall, the takeaway here is that AI onshoring is strengthening the compute story. The IMF keeps the macro picture steady yet unspectacular, and investors need discipline with those lofty valuations. Simple as stick with free cash flow generators and resilient margins, right?
Exactly right. And it leaves us with a key question. What should be broken down next? The options are the AI power grid build out, bank credit risks, or emerging market winners from supply chain shifts.
Tough choices, but all very compelling. I guess that wraps up our dive into today's money moves. Lots to think about for any investor looking to navigate this complex landscape.
Absolutely, always a balancing act between risk and reward, and it's essential to keep an eye on the evolving chain reactions in these sectors. Thanks for joining in on this chat.
Right, thanks for the insights.